Once again, we are all welcome back to FTGFx Lounge, where we share forex trading ideas. We listen to experienced guys like Marshall Trader to share with us how the market has been and where it is going now. So in today's session, we'll be talking about risk management, and we'll focus more on position sizing. So I wouldn't want to talk much. I'll hand over to Marshall Trader to take us through. So, bro, once again, we have the floor for you to share with us about risk management in terms of position trading and all.
All right, brother. So first of all, thank you for always inviting me
Yes,
to your podcast. Makes me very happy to share the knowledge with the other passionate traders.
yeah,
Position sizing is a very important topic. I think the last few conversations we had, there's a lot of questions about risk management.
yes,
And I'm glad that people are asking about this, because one of the mistakes of beginners traders is looking for profitability, for best entry points, and focus on the performance only, but don't focus on your defense.
Yeah.
They don't focus on their risk management. And position sizing is a very important topic of the risk management, because one of the mistakes that beginners trader can do is to think that you have a very simple rule of volume that you open based on your account balance.
yeah,
And this is a very big mistake, because your volume doesn't depend on your balance. Your volume depends on your stop losses, on the style of trading you have. I explain myself. If you have a $1,000 account, but you target take profit and stop loss at around 100 pips, you have to open small positions, because, for example, at 0.1 lot, that is $1 per pip. Well, 100 pips is $100. That's already 10%. It's already very aggressive.
yeah,
And you might think it's not, it's only 0.1 lot, but if the market is volatile, in one day you will reach it. So in one day you can reach 10% drawdown.
yeah,
But on another hand, if you are scalping and your stop losses are 10 pips, then 0.1 lot is only $10. That's only 1%. And now it's very acceptable. So you can even afford to open higher volume. That's why you need to, as part of your journal and as part of building your strategy, it's very important to know what type of trader you are. Where do you put your stop loss and your take profit? I give you my example.
yeah,
Because I'm like a day trader / scalper. When the market is going fast, I can close position within minutes. When the market is slow and the breakout doesn't happen very fast, the position can stay open one day, maximum usually 2 days. It depends, but the stop losses and take profits are quite tight.
okay,
They can be under 30 pips, 25 pips, it depends. But I'm going to go to these points as well, where to set your stop loss and take profit, because it's important.
okay.
So I check my account balance. Well, thanks to the robot now, I set it up automatically based on my balance, but I calculate the amount of that I want to lose or the amount I want to profit. So if I'm targeting, for example, 2% profits and 1% loss with a risk-reward ratio of 1 to 2, then I will adapt my volume so that if I reach my stop loss, it will touch maximum 1%.
Yeah.
And when I reach my take profit, it will touch 2%. So that's why position sizing is not something very simple. If you are not ready, it costs nothing to go to the demo account, test your lot size.
Yeah.
So you are not excited when you made 5 pips, you close and you made $20, 1%, 2%. But if suddenly there is a big pullback, big reversal, you end up losing 20, 30% because you didn't adapt your volume.
Yeah. So like you're saying, if I should rephrase it well, it means position sizing is more dependent on how much you are willing to lose and not the capital or the balance you have in your account.
Exactly.
Okay.
Exactly.
Okay. Is there more that you want to share with us? Maybe some practical experience that, in relation to position sizes that maybe led you into losing some money, and also what led you into maybe making some good profits for yourself in terms of position sizes?
Of course, there is a very important point.
Yeah.
Is averaging your position or scaling in your position. All of those things you need to be very careful. What do I mean by that? The number one reason why traders lose. By far, I can guarantee all the traders that I've met and myself when I used to lose, there was only one reason. It was poor risk management, because I was always opening more position when I was losing. So what happened is, you say there is a pullback, I'm just going to open another position in the same site, and when the market will recover a little bit, I will close. Then the market continues again against you, and you open again another position, so you start scaling. And you start scaling against your position. So whenever you lose more, you open another one, you lose, and then you end up at a floating of 30-50%. And this is how you can blow up an account in one day or 1 week, simply by doing this. This is what I mean by position sizing. When you open a position, if you want to open a maximum of 0.1 lots, and you say, I can open 3 positions at the same time, then the calculation is very simple. You shouldn't open more than 0.3, let's say 0.33 to be precise. Because if you open a second position, will be 66, and if you open a 3 position, it will be 0.1. So this is the thing. Position sizing has to include everything in your strategy. The numbers of position you open at the same time. I go to a second point, because I like to trade the basket trading. I trade a currency of a basket of currencies. So if I find an opportunity of euro and I want to trade euro sterling, euro New Zealand, euro CAD, and euro dollar, for example, that's 4 positions. If my maximum volume based on my strategy, my maximum position has to be, for example, 0.4. Well, if I'm going to open 4 positions, they have to be 0.1, no more. And this is another mistake, because sometimes you have an opportunity on the euro dollar, and then you say, but there is such a strong opportunity on the euro CAD, I will just open another position as well. And this is how you end up doubling the maximum volume that you allow your strategy. This is very simple and silly mistakes that will never benefit you. You will always end up losing if you don't respect your maximum position allowance for your strategy. Trust me on that. So this is for the loss. Now for the profits, we spoke last time about compounding, how compounding is important. It's very important to adapt your strategy based on your profit. So when you double, it happens many times that traders will double the accounts, and they will not adapt the volume. They will continue trading with the same volume. So you end up making 50% of the profits. So if you have an account with $1,000 and now your account went to $2,000, you can continue trading small. But if you want to respect your risk management and your position sizing, double the volume as well. If your strategy is working, there is no reason. And this is how the compounding can really, this is for aggressive traders. You cannot multiply an account by 5, by 10, if you don't adapt your volume based on your based when your balance is growing. So adapting your volume with the compounding is also super important.
So with this, for instance, so I was just thinking that, for instance, let's say I haven't been $100 in my account, and then I used to do a lot size of 0.01. Now I've been able to grow my account to $200. But what you said, it means I need to adjust my lot size to the current balance that I have. So maybe now I would want to go for a maximum volume or lot size of 0.02. If I should be correct in this sense.
Exactly. This is really important. You have to adapt your volume based on your balance, following your strategy, because otherwise you're not going to grow exponentially. This is really important for traders that they start with a small capital and they want to grow it. So like I have some examples that I turned. For example, when I started, I had a strategy that was trying to turn $100 into $1,000. So I could manage to do it in like 2-3 months by always increasing my volume. And trust me, it's not that difficult. I wouldn't do it with 100,000, because of course there is a risk to multiply your account by 5. There is a risk that you can blow up your account.
Exactly.
But this is a risk that I was willing to take, because what was happening, I was calling it, this was one of my strategy, but it helped me a lot to start to trade bigger amounts, to reach the $5,000 and $10,000 and above, to win the confidence to trade those amounts. I started with $100, $500, and what I was doing is that, imagine I had $500 to invest. I was opening 5 accounts of $100, and the objective is that each of them, I had to multiply them by 5. So $100 had to become $500.
Yeah.
So what do? I start with one account. When the account will reach $500, I withdraw 100 and I keep the 400.
Okay.
Now the second account, I blow up the $100. Let's say 100 became 200, then I blew it up.
Okay.
I had maximum drawdown. It was either I multiply by 5 or I burn the account. Then third account, I blow it. Fourth account, I blow it. Fifth account, I multiply it. And when you calculate at the end how much money I made, I had $500 into 5 accounts of $100. And because I multiplied 2 accounts by to $500, meaning I made $400 profit times 2, I risked $500, but I made $800.
Okay. So then it's better to have different accounts for what you're saying. That maybe maybe psychologically to also help you very well. We better that maybe if you make that profit, you can transfer part of the profit into another account where you would, or you can continue, doubling or not to say gambling, but increasing your volume or your lot size.
Yeah. Yes.
Oh, okay.
Yeah.
Okay, because for me,
this is very important for me, and it will be very important for traders. I will tell you why. Because whenever I was trading only one account, let's say, for example, when I was a student, I was saving some money, and I said, you know what, I will put $200. For me, it was all I could save at that time when I was a student. So I put this $200, and then I was so afraid to lose it, because then I need to save another 2 months, a little bit of money, just so I can start again. So it was so much putting me on the psychology, don't lose that money.
Yeah.
But the only small difference is that instead of doing that, I divide the account into 2 accounts of $100, and I say, look, don't lose it. But if you lose it, I have my rescue account. And because I was thinking like that, I was trading with a little bit more freedom, that I was safe. I could have another account. And so I was not blowing them up. I was not so afraid of opening positions. So an advice for people that they started with live accounts, if you want to start with 1,000, don't put all your eggs in one basket. If you want to start with $1,000 and you are comfortable with this amount, still don't use the $1,000. Divide it into 3 accounts and trade slowly with the 3 accounts. If you are not lucky, there is no successful trader. It would be a lie if I tell you I never blew up account. I blew up a lot of accounts. And even after 3 years, 5 years experience, I was trading really well and being profitable. Sometimes you have a surprise, you have a lack of energy, you make mistake, you always make mistake, and then you get hit by bad performance. By dividing your accounts, it's like having a little insurance that no problem, I will rescue it with my second account. So this is a good advice that I can give to beginners. Don't put everything into one account at the beginning.
Okay, I think that's a good advice. We will all take that. I would want us just to look at the next topic, like that we plan on talking about today: secrets of correlation. Maybe if you take us through what correlation is, and then the secrets, and then I'll pick up questions if anyone has a question on here.
Okay.
Yeah.
Correlation is extremely important. Correlation is really the key to success. Once you start understanding the market, you understand that everything is based on correlation. So the markets, especially for the Forex, this is very important for the Forex, for the currencies, because this is what I trade the most. So the currencies are traded against other currencies. So when you look, this is a huge mistake that many traders do. They're like, I trade only euro dollar. What does that mean, I trade only euro dollar? It makes no sense. The euro is not trading only against the dollar. It's trading against a bunch of other currencies that also influence the euro. There is a positive correlation between the euro and the sterling, meaning that if there is tomorrow a war or a crash in the sterling, the euro will drop because they are correlated. There is an inverse correlation between the euro and the dollar, meaning that if there is a quantitative easing, if there is a new FOMC, if there is a inflation that is increased, whatever, the dollar strengthen, then the euro will weaken against the dollar. It's always important to understand all the relationship between one currency and all the others. And the example is one day I met a trader, and this was I use it as well when I was going to make some events and stuff. I was always bringing with me a couple of Rubik's Cube. I don't remember, did I ever tell you about the Rubik's Cube or no in a previous podcast? Because I don't remember if we spoke about it.
No, you haven't.
So this is the secret of the correlation. Do you know the game, the Rubik's Cube?
Yeah, I've heard it somewhere, but if you want to break it down a bit for us, or it will be much.
The Rubik's Cube is this cube that has in each side a color, and you need to turn it and twist it until you make each side a color.
Yeah.
And there are some people that they do it really fast.
Yeah.
Yes. So in this Rubik's Cube, there is over, I don't remember the figure, but there is like over 1 billion possibilities. Okay. If I would give you a Rubik's Cube now and you would play every single day, 10 hours per day, you couldn't solve it by accident because there is too many possibilities. You will twist something and you will just mess up the other side, and then when you will have one side that is all white, the back of it is going to be a mess. The only way to solve a Rubik's Cube is to understand that whenever you make a movement in the front, it will affect the back. And you need to understand the algorithm of the correlations of all the colors. And as I would give you a Rubik's Cube and you couldn't solve it in a lifetime if you don't understand the mechanism behind it, there are some people that are solving Rubik's Cube under 5 seconds. Why? Because they understood all the different mechanism of the correlation between the colors. Once you understand this, and I learned to solve the Rubik's Cube and solve them fast, this is something that I can advise you to work on this mindset. Learn to solve the Rubik's Cube. All your listeners, learn to solve the Rubik's Cube. You will see it's going to make you adapt the same mindset when you're trading. When I look at the euro dollar, behind I look at what's happening in the dollar. On the side, I look at what's happening with the sterling. And in the front, I look what's happening with the CAD, for example. And everything is making a Rubik's Cube in my mind. And I'm thinking, how can I solve it? The sterling is weak, so the euro has to be a bit weak. The dollar is strong, which makes the euro a bit weaker. The CAD is strong, for example. And understanding all those correlations makes me understand if the euro is weak or strong across the board. If the euro is strong against the sterling, but is weak against the dollar, and is strong against the New Zealand, and is weak against the CAD, what do I do? What you should do? Nothing, because it's mixed up. The currency that you trade and the currency pair that you trade needs to be a strong pair against a weak pair. A weak currency against a strong currency, or a strong currency against a weak currency. You shouldn't trade a pair where both currencies are strong. It makes no sense.
So for instance, if I have GBP USD, I see that selling. What that means is the USD is strong and then the GBP is weak at that point in time. And I go look out for another pair, for instance, Euro USD, and I try to sell that too at that same point. It means the correlation between the two currency pairs are positive. Is it good, or is it a good decision to sell both? Or it will be like I'm just doubling the lot size on one, so it would be better I leave one and then pay attention to one. What would you advise on that?
It's good. If the dollar is strong against the euro and the sterling, and the euro is weak across the board, and the sterling is also weak across the board, you can trade them both, but with half the volume each. If you have to open, for example, one lot maximum, then you will open 0.5 on the euro dollar and 0.5 on the sterling dollar. And what is the advantage of trading euro against dollar and sterling against dollar is because of the power of the correlation. One of them is going to start to give you profit, and then the other one will take its time, and then maybe the euro will start to give you profit, and then the sterling will pull back. At the beginning, it will show that you are not making profit as fast, but when both of them are going in your side, then this is a huge advantage to reach your profit in a safer way. Let me explain myself. Even if you are the best trader in the world and you trade one currency pair, euro dollar, what is your percentage of chance to win or to lose? Let's say you sell euro dollar. What is the percentage chance to win or to lose in that position?
For me, it's a 50-50 because
Exactly. Exactly. You understand? So even if I'm the best trader in the world and I believe the euro dollar goes down and I sell, but it goes up, I lost. There is nothing I can do.
Yeah.
So I'm 50-50. Now, if I trade euro, dollar, and sterling dollar, I open two positions. What is the percentage chance that both of them giving me profit or both of them giving me loss?
Okay, so with the two, it will be 50-50 on both. That is 1-1 on both. For the two.
Meaning 25%. There is 25% chance that both positions are winning, 25% chance that both positions are losing, 25% chance that euro is winning and sterling is losing, and the last 25% chance that sterling is winning and euro is losing.
Yeah.
You understand? Now I have 4 possibilities. I don't have only 2. But you know what is the most important and advantageous of this? Is that even if the euro is winning and the sterling is losing, I can still be winning if the euro wins bigger than what the sterling is losing. So by working on this correlation, I don't allow myself to only gamble of 50-50. I can win or I can lose. I can even lose in one position, but if the euro at this, like I can open both positions, I can be minus $5. Because the euro dollar is giving me $10, but the sterling is giving me minus 15. But if the sterling goes back just at break even, now I'm in profit. I can close both of them. This is the power of correlation. You don't rely only on 50-50.
Yeah. So then I think the most important thing that needs attention has got to do with position sizing or lot sizing, because if I know my maximum lot for both pairs, like let's say lot 1 for both, okay, I should then share between both of them. So that's going to be 0.5, 0.5. Instead of me doing lot 1 on Euro USD and doing lot 1 on GBP USD.
Exactly.
Yeah, I think that's the trick. Well, but you see, maybe at the back of the mind, maybe the mindset is to, since I have 2 pairs, okay, going in the same direction, it would be better I go maybe lot 1 on both, like lot 1 on Euro USD and lot size of 1 on GBP USD, so that in case I'm making profit, I make more profits. Okay, but like you said, there's a risk.
And if you make loss, you'd make more loss.
Exactly.
So you should never go more than what your maximum allowance go. Never.
Yeah. I side with you on that. So let's say, for instance, like same on the correlation. If I'm selling Euro USD, maybe if I want to choose between the two, I want to choose one of them. Maybe I have Euro USD there, I have GBP USD there, and I want to just sell one. I don't want to go for both of them. I want to sell one. The correlation that I need to look at here should be the correlation between Euro GBP, right? Which one is stronger or which one is weaker?
Yes, exactly.
Okay. I think it's clear.
But you know what happens? I have done that thousands of times. You will look at the euro sterling and it will look like the euro sterling is going up. Meaning that the euro is stronger than the sterling. And you will say, you know what? If I wanted to sell euro dollar and I wanted to sell sterling dollar, but euro sterling is going up, meaning that the sterling is weaker than the euro, meaning I should sell the sterling first. But at the moment that you will sell the sterling, maybe it will make a pullback and now you are stuck in a loss. And at the time that you open, if the euro sterling makes a pullback, meaning that the euro would have paid you. So when you open them both at the same time, you know what you can do? If the euro dollar went into profit and you wanted to also sell the sterling, you can close your euro dollar into profit and leave your sterling dollar until it goes back also into profit. This is an advantage of really understanding correlation and not trading only one pair at the same time.
I think that's clear now. Please, I'll open the floor for questions. So maybe in the next minute, if you have any question, you can type in the chat box so that I ask on your behalf.
But what I want to say is that even if you are not ready, try it on the demo and learn to trade correlation up to 4 pairs at the beginning. Meaning that if you think the dollar is strong across the board and you have an opportunity, sell the euro dollar, the sterling dollar, the New Zealand, and the dollar CAD, for example. Dollar CAD will be the opposite. If the dollar is strong, meaning you buy dollar CAD and you sell New Zealand dollar. So and you will see how it works, and you will start to like it. Trust me, it will make you trade with much more confidence, because sometimes the pair are uncorrelating. Meaning you will start with a little bit of floating loss, then one or two pairs are going to start to go in your favor, and you will see you will be in profit, and you can close the whole basket even if you have only 2 pairs out of 4 that they are profitable. So learn to trade the baskets, and trust me, you will be happy.
Yeah.
Once you learn the power of correlation, you will have better results than you ever had by only trading 1 pair at a time.
Yeah. I think, and we have one comment from Don Perez the Don. He said, trade the basket. He would want maybe what you meant by that. I know you mentioned that earlier, but I don't know whether he wasn't on there, so maybe you can just share that with him. If you say you trade the baskets.
Hello? Sorry, my microphone was cut. We have a second session after, yeah?
Yes, we have a second session after.
What topics did you want to speak in the second session? Because I can take time to explain the basket.
Okay, in the second session. Because basically, I just wanted, if we are not able to finish this, we continue in the second session.
So let's start to talk about the basket trading. What basket trading means? Basket is not for basketball. It's like a basket where you put your eggs, meaning don't put all your eggs in one basket. What is a basket trading strategy? Is a strategy in which you put different pairs in one basket, and you always trade them at the same time. As I explained, pure statistically, mathematically, the more pairs you trade at the same time, the less risk you have to only lose or win. It's that simple. If you trade only 1 pair, you have 50-50, we said. You trade 2 pairs, you have 25%. You trade 4 pairs, maybe you have only 8% chance that all of them are losing at the same time. Yes, maybe you have only 8% chance that all of them are winning at the same time. But if your analysis is good and the currency is strong or weak across the boards, what will happen is that let's say if you lose $50 and you trade euro dollar, and then it goes back from -50 to -40. Are you making profit? You're not.
You are not.
Then it goes to -30. Are you making profit? No. But if you trade the basket and one position is at -30, the other one is at +30, and the other one is at -10, and the other one is at +50, then overall you are making profit. Even if 2 positions are losing and 2 positions are making profit, you are still making profit. So when you make a good analysis with 4 pairs at the same time, you have more chance to overall make profits than if you trade only 1. Because when you have 1, either you're at -$5 or you are -50 or you are -$500, you are still losing money. But when you trade several in the basket, then even if you have out of the 4 pairs, you can also have 3 pairs that are losing, but one of them made profit and covers all the loss of the other 3. You're still going to be making profit, and you can still close the basket. And someone can tell me, yes, of course, but what if all 4 are losing or all 3 are losing? That is because your analysis is not good, and at least it's clear.
Okay.
Because you have to be a really bad trader. Every time you open a basket, all 4 are wrong, all 3 are wrong. Then maybe open the opposite. But if you become a good trader, no matter if there is a pullback, if there is whatever, if you wait a little bit until the correlation goes in your favor, maybe 1 position will cover everything. Maybe 2 positions are going to give you more profit than the 2 losses. Maybe 3 positions are going to be profitable, and maybe all of them. But if you wait until the correlation moves in your favor, you will end up closing everything in overall in profit, even if you have 1, 2, or 3 positions losing.
I think I also do that a lot. Don't pay trade 1 pair at a go. I have maybe different pairs running, like you said, so that one makes up for the other. Because definitely you might have your stop loss hits at some point in time. So if you have different pairs going on, like you said, maybe one is losing at maybe one, like, let's say -5, the other -10, and you leave one to be in a trend for a while, and you are having maybe -20 on that, it's going to cancel out the losses that you made earlier, and that's going to give you some good profit. So I've also been practicing that, like you said, is a very good one. And like I always say,
it gives you a big confirmation. Sorry, continue.
Like I always say, the same way we leave our losses to run, okay, we leave our losses to run and give us huge losses. That's the same way we can also leave our profits to run to give us huge profits. So it's better you cut your losses early, you allow your profits to run. And like you said, if you have the basket, definitely you have few of them making up like huge profits for you to cancel out all of those losses. So for me, I agree with you perfectly.
Yeah, and it gives you a big confirmation if
Yeah,
you're really a good or bad trader, because you speak a lot to traders and it says, yeah, I'm good, but I had bad luck. There was a pullback, there was a news. I can agree if you traded only one pair. You
yeah,
trade one pair, it went against you. Then you trade another one, it went against you. You can say I have bad luck. But
yeah,
if you trade four at the same time and all four are against you, then you definitely have the confirmation there is no excuse that
yeah,
you've been trading really bad,
yeah,
and you need to go back to your strategy, go back to your journal, and go back to your entry point.
yeah.
And another very big important topic is about the entry of the basket that I will explain in the second part, because this is really important.
Yeah.
How to become a more precise trader, to trade like a sniper, thanks to the basket trading strategy. This is something very important. I will explain it in the second part because I need to take a bit of time for that.
Okay, okay. Then we'll do that in the second part. And there's this thing I would okay, let me ask you this. With there's this correlation that I have observed personally. So whenever USD is affected, so for instance, let's say we have news on maybe NFP, okay, NFP news, and then it makes the USD stronger. Okay, I've realized that normally when the USD is stronger, the JP or Japanese yen is also strong. So, for instance, if you have USD JPY, for instance, I have USD JPY there. In my mind, the news was just about USD, okay, but I have trades on CHF JPY. I then to realize that the CHF JPY is selling, indicating that the JPY is strong or getting stronger. But I never traded for the news that came out was for USD. Okay, so
Yeah,
for me, I just needed maybe some explanation on that because there, just for the conversation. Because if I'm doing this
yeah,
correlation, okay, the news has got nothing to do with USD at all. Per what we are seeing, or per what we see on the maybe in the calendars, but then you realize that it
yeah,
has, and in the end, it finds its way to have some impact on other pairs that have no relation. Okay, per what we see on the
yeah.
calendar, like I say, so maybe in the next meeting or the next one, we will, if you can throw some lights on that for us, it would be grateful.
Okay. How much time do we have left now?
But we have one, so maybe we can switch to the other.
So when we switch to the second one, I will give you the answer for that, because this is a very good question.
Exactly. All right. All right. So I think we have a few questions from Perez. He said, "Can you give me 4 currency pairs to put in the basket?" Okay, we will answer
Okay.
that in the next one, and then Perez has which of them for which means okay. Come in. Let me get the last question so that we go. He said more explanation on the correlation, which I think we have done that. Oh,
I
so
will explain. I will give an example of four currencies.
right, sure, okay, all right. So we can log out and then meet in the next meeting. Thanks. All right.
Perfect.
All right.
I'm going to answer your question because it was a very important one. It was, let's say, for example, you have an NFP, and sometimes it can affect Swiss franc, yen, even if they don't have anything to do with the news. You
Exactly.
can see this is a very good question, because there are two pairs, there are two currencies that are a little bit separated from simple correlation, and they are the Swiss franc and the yen. Why the Swiss franc and the yen are pairs that are a little bit out of the correlation? Because they are called safe haven currencies. What is a safe haven currency? Gold is also a safe haven commodity, is almost the only safe haven commodity. So you have Swiss franc, yen, and gold. When the market is too volatile and when the market becomes dangerous and people wants to get out of the market into a safer assets, they invest in the yen, they invest in the Swiss franc, and they invest in gold.
Okay.
So you will see those currencies strengthening, and this commodity of gold strengthening. For example, you have gold dollar. Gold is against dollar.
Yeah.
Dollar is strong, but sometimes gold dollar will still go up, meaning gold will still be stronger than dollar.
Yeah.
Why that? Because you will have a lot of huge traders, hedge funds, institutions. They will keep their money into gold until the market will stabilize, because they know that when there is big turmoil in the market, then it's better to go into those currencies. Why Swiss franc? Because and yen, because the Japanese central bank, the Bank of Japan,
Yeah.
the the Swiss National Bank
Mhm.
are influencing their currencies. So when they see that it's becoming too weak, they will buy their currencies in mass to keep them strong.
Okay.
So in this case, when the market is very volatile, if you enter the market and invest into yen or Swiss franc or gold, you are doing what the central bank is doing. So this is how you protect your investment as well. That's why, to answer your question, sometimes even if there are news that a currency is even stronger than Swiss franc or yen, they will still stay strong
Okay.
because the government will not let their currency become too weak.
Okay. Okay. I think I do see that in gold a lot. Gold and Swiss francs, like you're saying. So it's just confirming that. Yeah. Okay. So I think the second question is the second question was from, let me get, second question was from Perez. Okay, on here you say more explanation on the correlation, and if you can give four currency pairs that they can, try their hands on the correlation.
Okay, there is no four magic pairs. You need to analyze. You need to. Hello, can you hear me?
Yeah, I can hear you.
Okay. You need to analyze the market and look for them. There is no four pairs that you can choose at the same time. So first of all, I look at the dollar. I see if the dollar is strong. Then if I see that the dollar is strong against the euro, against the sterling, against the yen, against the Swiss franc, against the CAD, against the New Zealand, then I will choose four of those pairs. But before choosing them, I will look also at the euro. If the euro is weak, for example, against the New Zealand, against the CAD, and I start to do this exercise. But now I created a robot that makes the analysis for me. It took
Okay.
3 years of development, but it will look at the trend, it will look at the breakout, it will look at the lock candles,
Yeah.
it will look at a lot of things, the average movement, the range, breakouts, all of this, as I said, and
Yeah.
it will rate the currency, it will give it some points. So I open my markets and I see, for example, that the euro is at +4, it means it's quite strong. The sterling is at +3, is a little bit strong. The
Yeah.
dollar is at -6, meaning it's weak against the other 6 currencies.
Okay.
So I'm going to open a basket using 4 currency pairs of dollar. It could be euro dollar, it could be sterling, but let's say dollar is at -6, it's very weak, and New Zealand is at -5. I cannot trade New Zealand against dollar because they are both weak. So I have to choose strong pair against weak pair currency, and weak currency against strong currency. I cannot trade strong currency against strong currency.
Yeah.
If euro is very strong and sterling is very strong, why I'm going to trade euro sterling? Because it's just going to go up and down and I'm not going to take any breakouts.
Yeah.
If euro is very weak and New Zealand is very weak, why I would sell? It makes no sense. So I have to look for strong currencies against weak currencies. And when you find them, you see, for example, New Zealand dollar is going on a downtrend. So New Zealand is stronger than dollar. You see that sterling dollar is going on a downtrend, about to make a breakout. I have already 2 pairs against the dollar. I don't have to take 4 if there is no 4 opportunity.
Yeah.
4 is better. More than 4 becomes too complex and then it's a big mess. And I realized by really testing 1, 2, 3, 4, 5, 6 that 4 is a very good number.
Yeah.
And when I find 4 of them, of a strong currency against weak currency, I open them at the same time, and I really wait for the best entry point. Because let's say, for example, one of them made a pullback and the other ones are a little bit ranging, I wait. But when all 4 of them start to move and approach a breakout of the support at the same time, I would sell them all at the same time. And this is how I increase my chance that one breakout is good, but 4 breakouts happening at the same time, meaning that really the market wants to push down, and it will happen with much more chance than if it was only one currency pair.
Okay. I think that sounds good. Perez, are you okay? Are you cool? I'm okay with the answer. You can just write that in a chat box for us too. Please, any more questions? And Master Trader, there's one question that I wanted to ask the last time. The last time you mentioned that when there's a flash crash, okay, the brokers don't pay, or they wouldn't even want to pay for that. But when there's a flash crash and you as a trader make profits, they wouldn't pay. But if you make a loss, They don't care. They will take the money. For me, I needed some clarification there, like understanding more, maybe what's the thought process of that or what's behind that. But I think I didn't have the chance the last time. If you can throw more light on that for us, I think would be
Okay. I mean, look, I don't like to as a trade. Sorry, can you cut your microphone just after? So because I hear a lot of noise. Okay, thank you. And then when I finish, thank
yeah,
you, brother.
yeah,
So the point I don't like to talk bad about brokers because we make money from brokers and most of them are honest and are trying to do a good job. So
yeah,
this is not something bad about broker. It's a reality about what's happening in the market. Let's say even if you trade crypto and suddenly the Bitcoin is crashing.
yeah.
If you were buying and you blow up your account, then you lose money. If if you are selling and you're supposed to make a lot of money, sometimes even the big crypto exchange they will freeze the trading, and you won't be able to close your positions. So this is the same thing. The brokers are trading, are sending their orders into the market. When there is a huge flash crash and the market is flooded with orders, then the liquidity providers will not be able to handle all this flow of crazy orders. So maybe they will cancel them or they will freeze them, meaning that the broker will not be able to execute your trade properly or close it properly. That's the
Okay,
reason why. I mean, most of the brokers are honest if we are talking about normal condition. But if suddenly there is a crash of Swiss franc and you open one lot and you're supposed to make $1 million, don't think that the broker is going to pay it because nobody's going to pay them. No, the market will not allow the broker to execute those trades. So this is very rare cases. I've seen some example on the flash crash of the Swiss franc, for example,
yeah.
or the huge crash of oil when oil even traded in negative prices.
Mm-hmm.
Then even if you are making huge amount of profit, your trades will not be executed and most probably they will be cancelled. You need to be prepared with that. But that's why, even if you are trading big amounts, this is an advantage of not trading only one account, because if you're really unlucky that at this time you were opening a position and you blow up your account, even if you've been trading really good for the past year or two, then unfortunately these are some things that they can happen, and you need to rebound and start all over again.
Oh, that sounds unfortunate because for me, I think if I place my trade and maybe the liquidity providers are not taking it, and as a result of that, the brokers are not going to get paid, then the money should have been in the account. It should have still been in the account.
Yeah.
For me, that's how like I'm thinking that should have been the case instead of maybe if the account should get blown. Is it that they would have, for instance, I place the trade, okay, the trader executes it, and then the liquidity provider doesn't continue with the trade. Is that when I lose my money, or when I place the trade and the broker doesn't even execute it because the liquidity provider is not taking it anymore? Where do you lose the money in case there's a flash crash? Like, I want to understand that flow, where exactly or what is really the cause of that.
The flash crash, well, if there is a flash crash that goes against you, you lose your money because the market couldn't execute at your stop loss. For example, even if you have a stop loss at $100, but the market crash and you lose $1,000 and you blow your account, your stop loss might not be executed, because I'm talking about a flash crash when the market will lose 1,000 pips in some few seconds.
Yeah.
It's just like a crazy NFP, for example, a crazy FOMC. You can imagine that there is a crazy NFP or a huge change of interest rates.
Yeah.
If you put your stop loss at 20 pip, maybe there can be a huge slippage and it can be executed at minus 100 pips. That's why you always have to be careful during time of volatility that your execution is being respected.
Yeah. Okay, I think it's clear for me now. So for me, I think I'm clear. If anyone has a question, you can share with us in the chat.
I see that there is a question from Silencio.
Yeah.
To know about Forex Factory, to check about the strength of the currency.
Yeah.
I will tell you 2 ways to check the strength of the currency. Number one, you have to analyze the markets alone. You have to look at the market when it's making a trend, an uptrend. it's making new breakout, new highs. Suddenly you have some strong candles that they are breaking the market and doing breakouts. Then you have your confirmation that there is a strength on this currency pair. Then you can take a piece of paper or an Excel file and you write all your currency pairs and you look at euro dollar and you say it's up, it's making a breakout of the resistance, it's having a strong bullish candle. I will give him 1 point against the dollar. Then you do the same thing for all the others. This is one. You have to analyze the market yourself. Then the second one to make it in FX Street or in Forex Factory, they have some tools. Have a look. Maybe on another podcast, I will share a link. I don't have it on the top of my head, but they are called Community Outlook or Market Sentiments. These are a very good way to analyze the market. So when you see, for example, that euro dollar is at 80% sell and 20% buy, meaning that most of the traders are going on the sell. So if the market is going up, it's a confirmation that the euro is strong, for example. So have a look at the community outlook and have a look at the market sentiment on those websites. You will see there is a list of all the currency pair and then a bar that is green and reds.
Okay.
Hello?
Yeah, hello, I can hear you. Can you hear me?
You're sharing your screen?
Okay. Yeah, I'm trying to share the
sharing
screen.
Your screen. I thought it was cut.
No.
Look for a Forex Factory community outlook, or FX Street community outlook or market sentiments.
Right.
And and then you will see this is helping a lot because it's giving you the overall market sentiment.
Yeah. FX Street. Okay, let me just do for FX Street. Yeah. I think investing.com also has something like that.
I think it's investing.com. That's a good point. Because I don't see it now on the menu of Forex Factory.
Yeah.
Check FX Street, check investing.com.
Okay.
And I have the link saved on my laptops, but if you search it.
Okay. I know a bit about that. Where they have the analysis done with the currency pairs, and sometimes they even indicate the indicators that they use and what they think could be the outcome and all of that. Let me.
Yeah, they indicate the percentage of buyers and sellers.
Yeah. Okay, so it's loading up. So, but I think we have some news coming up, or high impact news coming up in the coming week. I don't know. We can just, while the other page is loading, maybe I just share with all of us. And yeah. So these are high impact news coming up in the coming week. That's from 2nd April. That's today to the 8th. Okay, so we have CPI for Swiss francs coming in. Cash rates for Australian dollar, and I think with all of these things, we need to be, as traders, we need to be abreast, or we need to understand them so that they don't take us by surprise, like you mentioned earlier. Would you want to add something to this, like these?
I think when you are not sure about how the market is moving, try to avoid the very important news. Let's say now this week, all of them are important, but which one? Definitely on Wednesday, the ADP. The ADP, first of all, is really important because it's correlated with the NFP.
Yeah.
It's also an ADP. It's also an NFP made by the ADP agency. So the ADP and the PMI will have strong volatility. Then again on Thursday, you have the unemployment claim for the dollar will be really volatile. And Friday, definitely you have NFP and unemployment rates.
Yeah.
So all of those are super important. If you are not sure, avoid them. The first week of every month, when you have ADP, unemployment claims, and NFP on Wednesday, Thursday, Friday, avoid those 3 days. Or trade them on demo. Once you start to really understand the correlation, I will be 100% honest with you, I don't even stop anymore. I don't care, because most of the time that I trade and the NFP comes, everything closes into profits. Because once you really understand the power of correlation and you know where the market wants to go,
Yeah.
then the news is only accelerating your profit and makes it faster.
Yeah.
But at the beginning, don't be overconfident. Don't rush into this. Try it on demo. Try it on live account with very small position and see. Now, at the beginning, even when I started to be profitable, I continued to avoid them. But at a point of time, when I see that 9 times out of 10, I still end up closing everything into profits, I
Yeah.
don't avoid them. If one day there is a weird news and it touched my stop loss, no problem. Most of the time, it will always touch the profit. So
Okay.
I don't avoid any news anymore. I don't even look at the calendar.
Yeah. So what that means that the calendar, which part of the fundamental analysis just comes in to push the direction or whatever you have already in the technical analysis, I guess.
Exactly.
Yeah.
Exactly.
I think my internet is very slow here, so maybe I'll check up that and share with the community
We'll
later.
give we'll, yeah, we'll give the direct link on another podcast.
Okay.
If you search for community outlook and market sentiment,
Yeah.
and you look for Forex Factory, I'm quite sure that Forex Factory have something called community outlook, and it shows you the average entry price and the percentage of buyers and seller. And the average entry price, it's very important, because when it's becoming very far from the current price, it means that a lot of people are stuck on the opposite sense,
Yeah.
and it will take us to a huge, I keep saying secrets, because this is things that I've discovered and I'm sharing with you today, that I've discovered with a lot of years of research. It's the concept of being a contrarian. But I think we have to give this topic to another podcast,
maybe,
because otherwise we can speak for hours.
Yeah.
Remember to make a podcast on the concept of being a contrarian trader, because this is extremely important.
Yeah.
And in that podcast, we will talk about the community outlook, and I will share my screen, and I will show you how to analyze the community outlook.
Okay. Maybe then I think we can push that to next week so that we can let this rest then. So yes. I think for me, I'm okay with all the explanations that you've shared with us, or the knowledge you've shared with us so far. If anyone also has a question, maybe you can use a minute to chat, type it in the chat box. But maybe after a minute or two, we'll just bring it to a close.
I want people, when we start the chat, write your country, where you're from. Okay. I want to know if you are from Ghana, from Nigeria, from South Africa, from Mexico, from Algeria. Write your country, guys, because I like to know the community where you're from.
Okay. The Mustafa, Ghana.
Perfect. Thank you.
Yes.
Thank you very much.
Yes, Silencio too from Ghana.
Very good.
Yeah. Let's see.
Lovely.
Yeah. Maxwell, Ghana. I think your countrymate couldn't make it today. I think he sent me a DM that he wasn't able to, because he'll be going to work and all.
It's all right.
Yeah.
It's saved, and we will continue the podcast and we'll grow the audience. But we have most of the people from Ghana, which makes me very happy, and it's a confirmation that we have a lot of people from Ghana, brothers and sisters, that they want to become martial traders and successful traders in general. So one day I'm sure we'll meet, brother, in Ghana, in Accra, wherever, and we will make an event there, and we will get to meet the people and show them live, because it's not only about talking and making podcasts, but what I love the most is also sharing my experience live, opening the charts, and this is one thing that we can do next time. When I show the community outlook, we can make a Zoom in which I will share my screen, and I will share my charts, and I will show you how to analyze the markets with all those different factors. I think people will like it.
Yes. Maybe we can plan that for next week. We can talk about it and then plan that. Yeah, hopefully. So I think we are done for today, and we appreciate your time and your expertise in making time for us, coaching us and teaching us on how to go about most of these things. So once again, we appreciate a lot.
My pleasure. Anytime. We continue doing that and we make it big.
All right, sure. Okay. Thanks a lot. See you next week.
My pleasure. Take care, everyone.
Sure. Bye-bye. Bye.